One of our jobs is obviously risk management, and that determines, we have to determine obviously which way the markets are going. We're looking at charts, we're looking at price action. That is telling us, it is informing us. But not all trades carry the same amount of risk, and we're using the charts to evaluate where the risk is, and we have procedures to avoid and minimize their impact, and that's all about risk management in trading. Some people confuse the word risk with, oh, it's risky, it's dangerous. Financial risk, completely different. That's what money managers do all day long. They're managing risk. Yeah. Anyway, it's no coincidence that we have our workshop where we discuss past trades that are coming up, and also prepare for the week ahead. We do it on a Monday morning because there's no point preparing for the week ahead on Wednesday. A little bit obvious really, but we like to look at my section. This is where we look at the key releases, because there are a ton of releases coming out every week. If we look at this filter here on Forex Factory, so we use Forex Factory because it's a very easily digestible visual presentation of the events on a day-by-day basis. And if you click on this filter, you can select which ones you want to look at. Now, they're color-coded. You can go for the red ones. Obviously, we want to know about the high impact ones. That's in Forex Factory's opinion. Morning to you, John. Morning to you, Paul, Owen, Ian, two Ians. Also, we look at the medium impact ones. The problem with the low impact ones, and also the non-economic ones, are like holidays and stuff. We like to know what's going on in those as well. But if we select the low impact ones, look what happens to all the data that we're looking at coming out. This is a quiet week. There's just too much to digest. And you will immediately say, well, which ones do I look at? There are far too many to look at. Well, we just look at the high impact and some of the medium impact ones, but I will go through all of that. So the key releases that we all like to follow and the market follows are really ones that center around what's called monetary policy decisions, and those are the meetings of these various central banks that we track, the likes of the European Central Bank, the Bank of England, the Federal Reserve, the US Central Bank, the Bank of Japan. These are all decisions that affect monetary policy, where they decide on interest rates, and interest rates affect everything. They affect the money that you borrow, the money that you have on deposit. They affect the money that companies borrow. They affect bond yields. So they affect everything, our pensions. So it's absolutely key that we track those, because they have a direct impact on the markets. Central banks have principally one mandate given them by their respective governments, and that's to maintain price stability. What do I mean price stability? By price stability, I mean inflation. We all know over the last couple of years, inflation has just taken off. It was taking off before the Ukraine war, and the energy crisis then really kicked it into the stratosphere. Fortunately, it's all coming down now, but we focus on that. There's only one bank that has more than one mandate that I know of, and that's the Federal Reserve. The Federal Reserve, the US Central Bank, has two mandates. One, to maintain price stability like all the other central banks, but also to foster full how do we get to the section to cancel the yellow ones? Click on this symbol here, Ian, right at the top of Forex Factory. It'll come up with the filters. Uncheck the yellow one, make sure the tick is removed, and then click Apply Filter. Then you won't have all that really non-consequential data. It's just not interesting to us anyway. The US central bank, as I said, it has to maintain price stability. Full employment. Full employment means that we have to watch what employment data is doing in the US. Hence the reason when we get to the end of the month, and this is the end of January, why non-farm employment change is so important. Along with interest rate decisions, the non-farm employment change or employment data in the US is by far and away the most key important releases during the month. Other important events are things like elections. And we've got a lot of elections this year. Our own, sometime, who knows when, sometime probably in October time, November time. And we've got the US presidential elections. So it's very important just before an election, perhaps, to really take evasive action, because anything can happen to the markets. We never know which way they can react. We might know what the polls are saying, but we never know. And no one knew what's going to happen when Trump got in and then didn't make it. No one knew about Brexit. There are shocks and surprises all the way along. So that is the reason why we go through this calendar. So the key ones being, as I say, anything that affects monetary policy decisions to do with maintaining price stability. And guess what? That's all that CPI data. Yeah, manufacturing data, anything that affects anything that tells us about the economic activity in an economy that could impact the central bank. But the price, the inflation data, the CPI data, and the one that the Fed uses, the PCE, has a direct impact on central bank thinking. Plus, also, we like to hear what central bankers are thinking. So we have the FOMC minutes this week, for example. Whenever we had any politician, any central banker speaking, we like to know about them as well. Flash manufacturing and services mean, Peter, an economy is made up of two sectors, manufacturing and services. In the UK, the services sector is about 80% of our economy. In the US, it's about 65, 70, so they have a bigger manufacturing sector. We like to know how they're doing. And the flash reading is the first reading. And there are companies that gather this information from purchasing managers. I actually do one for Market, which is part of S&P Global on behalf of one of our companies. So I have to report monthly about what we're seeing in terms of sales, in terms of prices, etc., etc. So that's what makes up these numbers, and it tells us how an economy is performing. I'll get into it later on, but in a quieter week, we're looking at manufacturing, we're looking at the FOMC this week, and we're looking at that's pretty much it, really. I think German EFO climate at the end of the week is quite interesting as well. But anyway, let's get on with my bit anyway, and I'll explain what's been going on last week, and we can have a look at that, what's coming out at the end of my piece. Last week, we've been talking about inflation. Last week, which is what I want to just quickly go through now, we had CPI data out. Yes, that has a big impact on what the Federal Reserve are thinking in the US. We also had our own CPI data out here in the UK. Rather curiously, US inflation actually fell less than expected. And that sort of further dampened down hopes of a cut in US interest rates in the next sort of 3 months. If you remember, at the start of the year, we were anticipating, or the market was anticipating, gosh, I think it was, how many cuts? I think it was about 4, 5 cuts, something like that. Anyway, it's no longer that. In fact, no, I think it was 7 cuts. Anyway, there is unlikely to be any US cuts in US interest rates before June now. And back at the start of the year, we had an interest rate cut forecast at the March meeting, March the 20th, if you just look at the tab at the top there. And what's happening now is that the market, there's a 90% probability of rates staying unchanged. Go to May. 65% probability of rates remaining unchanged. Go back a month ago, and there was a 50% probability of them being cut. Go back 2 months or a month and a half ago, and there was almost a shoo-in that interest rates will be cut again in May, but they're not going to be. We're going to have to wait until June, the 12th of June, for the first cut. And even then, it's not 100% probability, it's about 71%, something like that. So there we go. But last week, UK inflation came in better than expected. At 4%, lower than the forecast of 4.1%, as you can see here on the screen. So UK markets, as a result, had a better week. Why did UK markets have a better week? Because of that CPI data? Basically, because it means that with inflation forecasts lower than, coming out lower than forecast at an unchained rate of 4%, immediately the market priced in the probability of the first rate cut here in the UK at 65% in June. Put it in your diary, June, there's a 65% probability that rates will be cut here in the UK. That's obviously what the markets are thinking. It may not be what Andrew Bailey, the governor of the Bank of England, and his Monetary Policy Committee members are thinking. That's not always they don't always agree. Sometimes the committees then catch up with the markets. Sometimes the markets catch up with the committees, a bit like in the US. Before the CPI data last week, there was a 40% probability of a cut in June. It's now 65%. Anyway. But despite the positive news, I've mentioned the Monetary Policy Committee, they have a say in things. They've got a new member of the policy committee called Megan Green. She was appointed last year. She said that in light of the persistence of UK wage and services price pressures, and I think she's referring to the increase in the minimum wage, which is going up by 9.5% in April. She said, I think policy will need to remain restrictive for some time. Now, then we get the debate, well, how long some time, for God's sake? The market, well, I expect that the Monetary Policy Committee and members like Megan Green are more hawkish about interest rates than the market appears to be. The market would love to see interest rates come down, and there is a balance with central bankers. You know, they don't want to keep rates too high as an economy slows down, because it's like steering in an oil tanker. You have to think 12, 30, 15 months ahead, and it's quite tough. And they're damned if they do, damned if they don't, I'm afraid. Anyway, US inflation, as I said, disappointed last week. The headline inflation was up 0.3%. That's 3.1% year on year, and that's stronger than the plus 2% that was expected. Actually, it says plus point. Yeah, that's the headline one there, plus 0.2% that was expected. Core inflation, which is the one that the Federal Reserve likes to look at more, and we like to look at more. Core inflation is when you strip out those components that have caused inflation to take off, over 2.5 years ago now, and that those volatile components, believe it or not, are the energy and food components. And you think, well, why strip out energy? That's the reason why it's gone up. That's the precise reason why we do, because we want to see now what's left. What prices are rising now because of the energy crisis. And that's almost like the hard baked in inflation reading. Anyway, that was unchanged at 3.9% year on year, up 0.4% from the previous month. And that was stronger than expected. So immediately, forward interest rate agreements, like swaps, rose while Treasury yields fell. What I basically mean is interest rates ticked up. And that's because traders continue to dial back when they expected the Federal Reserve to start cutting rates. Traders now expect the first rate cut, as I said, in early June, while a month ago, as I said, traders still expected the first rate cut to be in March. That seemed a real long way off now, as the Fed has signaled only 3 rate cuts this year, rather than the wildly optimistic, well, I said 5, I think it was 7 cuts that the markets were expecting at the start of the year. And I think this readjustment that you're seeing going through over the last 6 weeks, I think it's close to running its course, because come December, the markets are only forecasting rates to be somewhere around 4.25 to 4.5. So that would only be 4 rate cuts by year end rather than the 7, which is more in line with Federal Reserve thinking, who have said that they expect rates to be cut 3 times this year. Are you still with me, everyone? I hope you are. That is the reason why we want to look at those events, those releases that affect what the Fed's thinking and what could affect the Fed's thinking. This is great what we look at here, because this is what the market thinks, and this is updated every second, every minute. What we don't get is a minute by minute update from the thinking from the Federal Reserve or the Bank of England, the European Central Bank or the Bank of Japan, because they only meet once a month. Occasionally they speak like Andrew Bailey and some of his NBC members, and when they testify to Parliament, occasionally they'll drop hints. We see minutes, etc., that give us more colour. But that's what trading is all about. We're not trying to interpret what all of this means. Our job is to read the charts. The charts hold everything. Yeah, that tells us where the trend. You may think the FTSE should go down. If the chart says it's going up, it's going up. Try not to hold too many fundamental views when you're trading. The market has spoken through the charts, and that's what we need to interpret. That's what we do. Okay, what was the other thing that was going on? Yeah, Japanese markets. I had a couple of emails about Japan, about what's going on there. Rather interestingly, Japanese markets, and this is the Nikkei, they really do power ahead. And I think we mentioned last week that it hit a multi-decade high, and they tacked on another 3% last week. That's the Nikkei. The news that the Japanese economy shrank for the second consecutive quarter, you think that would be quite bearish for the economy, for the market, and actually it propelled the Nikkei even higher. And the reason why is that over the last few weeks, we've had feedback that the Bank of Japan is considering ending its ultra loose monetary policy that they pursued whilst all other central banks have been tightening interest rates. Anyway, the plan to raise rates in April, as the Bank of Japan has signaled, has now become a little more muddied, because the Japanese economy is not doing anything like as expected. I mean, the Nikkei, the fourth quarter GDP, I think was down. What was it? Down 0.4%, whereas predictions were for a rise of 0.2%. That's not an economy that's doing well. Is everyone okay? Any questions? Anything? Please let me know. I hope it's useful. It's important that you understand why we need to keep looking at this data, but we just need to make sure we note down those key releases and the date and time that they're coming out, and you won't come a cropper. Currencies, let's have a quick look at those. Obviously, they're also affected by interest rate decisions. Movements in the forex markets actually last week were really dominated by the outlook for interest rates here in the UK, in the US and Japan, as we just mentioned. For example, sterling US dollar, let's have a quick look at that traded down close to the lows for the year. I mean, it's been pretty quiet on the FX markets, really, unusually so. And that caused, with the inflation data, that caused bets to be increased for a rate cut in June. But you've also then got combined with the expectations that the Federal Reserve will not be cutting rates until June, having, the market view was that they were going to cut earlier than that. Because remember, lower rates, not good for the currency, because you don't get such a good return, so you're not going to hold your money in dollars. You'll put them in a high yielding currency. So lower interest rates generally feed through to a weaker currency, whilst higher interest rates lead to a stronger currency. The same scenario actually is what affected the Japanese yen last week, which, as I said, reacted to the surprisingly poor fourth quarter GDP data. And it impacted expectations for an increase in rates. If they're not going to increase interest rates from their ultra loose zero interest rate at the moment, then why would you hold Japanese yen? And believe it or not, a weak Japanese yen is good for the Japanese stock market. You've got all those real big exporters that do even better when there's a competitively or lower valued Japanese yen that makes their exports even more valuable in Japanese yen terms. Yeah. Finally, commodities, gold, well, it tracks the dollar. Not surprisingly, you've seen the dollar recovering from last Tuesday. Gold is recovering as well, and it basically reacts to the appreciation in the US dollar, because in the face of stronger inflation readings. Gold is priced in US dollars, oil is priced in US dollars, platinum, palladium, silver, a lot of base metals are priced in US dollars. Anything priced in US dollars will fall if the dollar rallies, and gold's no exception. And gold is rallying now because the dollar is falling back. Look at the euro. That's sort of you can track it pretty closely, really. Brent crude, or UK oil, rose another 1.5% last week, something like that. I think the escalation in the Middle East doesn't really show any signs of being resolved, and I think there is expectation, just listening to the news wires this morning, about the IDF then attacking a plan to attack Rafah if the hostages aren't released by the 10th of March. Obviously, that's a bit of a ticking time bomb there. Yeah, that really does need to be resolved before then. Anyway, let's get on to the calendar. Here we go. Let's get on to the right week. Here we go. Holiday today in the US. It used to be called George Washington's birthday. It's actually called President's Day. The markets are shut, so no US influence. And when that happens, it doesn't mean that the markets aren't going to move. What it means is there is less liquidity. But often when there's less liquidity or participants, if you do get a defining bit of news, something that we didn't plan for, it can have a bigger effect on the market. So it's so important to stay focused even when there is a holiday in Europe or the UK or the US. Go through the same processes regardless. We've also got the Chinese markets are back after their long week's holiday last week, in celebration of the Lunar New Year, Year of the Dragon. Yeah. Anyway, no central bank policy meetings this week, so I think we're going to be focusing on those manufacturing and services PMI datas that I just explained earlier on. Yeah, let's go for it. So nothing today. Tuesday, we have a policy announcement. See, this isn't really the People's Bank of China. They don't really have a meeting. They just make an announcement every month about their interest rates on their 1- and 5-year loan rates. And there's going to be what traders are expecting, what they've signaled from the People's Bank of China is a modest cut in the 5-year loan rate. They've got a big problem in China. They've got deflation, so prices falling, so businesses are struggling to put up prices, whilst at the same time the economy is really not performing particularly well. And this has been the case ever since the end of the first quarter last year, after their disastrous rolling lockdown because of the pandemic, which is just, I'm sure they wish they hadn't done that. Anyway, it's probably always darkest before the dawn, but there are signs that the Chinese economy is starting to stabilize. Bank of England, these policy hearings. So this is where the Bank of England governor, that's Andrew Bailey, and 2 or 3 of the members of the Monetary Policy Committee, they go to the Houses of Parliament and they testify on inflation and the economic outlook. And that's before the Treasury Select Committee. And that actually is quite interesting because it's all to do with inflation and the economic outlook. So they can drop hints about what's happening on interest rates. And if that happens, it'll affect the markets. It's almost like saying, hey, well, this is what we're thinking, and that's what's going to influence our decisions when we next meet to deliberate on what we're going to do with interest rates. As I said, we're not expecting any rises. Obviously, we haven't had any rises for 4 months here in the UK, but the first cut, the market believes there's a 65% probability in June. Seems a long way off, doesn't it? Bearing in mind it's the 19th of Feb. Anyway, a lot can happen before then. A lot does happen, as we know, ever since the start of the year, just 7 weeks, and things have shifted dramatically on expectations for interest rate cuts in the US. Yeah. Anyway, talking of the US, Wednesday, it's not really that heavy calendar, I'm afraid, this week. FOMC meeting minutes. In the UK, we publish our minutes the same time as we publish the Bank of England publishes its monetary policy statement. And I don't know why the US waits 2-3 weeks to publish its minutes. Do they like to change them? I don't know. I mean, nothing's going to change because they're minutes. Anyway, these are the minutes from the last policy meeting held on the 31st of January. Since the last meeting, obviously traders have dialed back their overly dovish stance on interest rates. What I mean by dovish is where you think rates are going to come down or not go up, compared to what the Federal Reserve were thinking. But you've had some pretty strong inflation readings. That's the PCE data, the personal consumption expenditure, the one that the Fed watches, and also CPI, stronger than expected and really strong unemployment data. Do you remember the one in at the end of January, beginning of Feb? It's ridiculously strong. So 353 versus 187, and they revised the previous month up over 120,000, 120,000. So incredibly strong data, and that's why traders have dialed back their expectations. And actually, to that extent, I think the minutes are unlikely to upset the apple cart at all this week, because I think it's highly likely that the market now is aligned with Fed thinking, if you know what I mean. But US dollar and US assets will be sensitive to that release. So that's one to put in the calendar, but it is after UK market shut, but it's before we do our end of day. So, and for intraday traders, you might want to make a big note. 7 o'clock in the evening, that's when that happens. Then Thursday, it looks like the busy day is Thursday, but it's all the manufacturing and services PMI data, and it's almost coordinated. You've got the UK, US, and the European Union, Eurozone area that release all their data on one day. So you'll get all the European, UK data out in the morning, and then the US data comes out at 2:45 in the afternoon. To sum it up, there looks to be a modest improvement. So if you look at the Eurozone as a whole, they separate out French and German ones for some reason, but it's really the Eurozone as a whole. You can see that there's a modest improvement in both manufacturing and services data. But remember, below 50 means that those sectors are not expanding, they're contracting. It doesn't bode well. Conversely, look what's happening in the US. Oops, what have I done? Didn't want to do that. They are both above 50. So only just expectations for the manufacturing, but that was always below 50. But it's just a different, it's chalk and cheese. US economy, their growth last year compared to what the anemic growth in the Eurozone and in the UK. In fact, we're contracting here in the UK, as you know. Yeah. Sorry, manufacturing and services here in the UK, sort of similar to the Eurozone, with a modest improvement in both sectors expected, and that'll affect all those relevant currencies and assets in those particular countries. So basically, virtually all of the Western economies, bar Australasia and Japan, which aren't West, obviously, but they're included in developed economies. That's what I should have said. And then we jump to Friday, and there isn't much coming out on Friday, but the German IFO Business Climate Survey. This is a very broad-based survey of, manufacturers and services and retailers and God knows what. And the results over the past 6 months have really been tracking sideways as the German economy has really struggled. Because it's been struggling because of the demise of the Chinese economy post the ending of the rolling lockdowns. And China is a key target market for Germany. And then you had the Ukraine war, 2 years ago, but the energy crisis that's been wrought on all of us, but it has really affected Germany because it depended on half its energy supplies coming from Russia. So I think it's had a really, an even bigger impact on the German economy. Certainly bigger than the impact that's had on the UK economy, for example. But the UK Chinese economy, yeah, it's starting to show signs of stabilizing. But as I said, I think few businesses are able to raise prices because the economy, as I said, is sort of navigating its way through a period of deflation where prices are actually falling. So, okay, we're close to finishing. It's 27 minutes past, but Stuart was a little bit late handing over. I've got one more thing to say. Fourth quarter earnings. This is happens every quarter. And the quarterly earnings, take about 3 weeks or more. Some report very quickly after the end of the quarter, but we're at the tail end. This week, the two notable ones are Walmart, which is one of the biggest bricks and mortar retailers in the world, actually, certainly in the US, and Nvidia. Who knows who Nvidia are? Well, up until halfway through 2022, no one knew who Nvidia are. They're a chip maker. And Nvidia, they originally purposed their new super chip that they developed for crypto mining. So it was a heavy duty chip costing $40,000. But guess what? No longer, because that chip actually is used in AI. Some of those heavy duty, those mass language learning, I can't remember what those modules are called, but anyway, they need a lot of power, and it's those NVIDIA chips that are key. And it's those NVIDIA chips that have powered NVIDIA 500% higher since the start of 2022. It's worth 1.8 trillion, and it's the third most valuable company in the US. How about that? Bigger than Alphabet. Yeah, incredible. There we go. Thanks very much for listening. That's what's coming out this week. Do have a good rest of. How much will all the elections move the markets? Elections really do move the markets, but how much they move them, I don't know. Typically, we tend to rely on polls, which is mad because the polls are always wrong, nearly. Anyway, listen, all the best. I've got to shoot. You probably need to get on as well. Have a good rest of the week. We'll catch up again next Monday. All have a good rest of the week. All the best for now.